Wendy, thank you so much for being here. I am so excited for you to share on Investing 101. This has been a long time coming in terms of our content, and you are just absolutely the expert. So I'd love for you to introduce yourself and tell us, how you got into this role.
So right now I'm the chief investment officer of a commercial real estate company. And prior to that, I was a stock trader and investment banker on Wall Street. And I realized that some of the guys I was working with there, even though some of them had a ton of money, but they actually spent more than they were making. So I was like, basic financial literacy. So now what I'm working on is a financial literacy platform, kind of skewed towards women, but it's really for anybody who needs it, which is kind of everybody right now.
Yeah, that's so great. I have always been very intimidated by investing. And I think, actually we just did a research study that showed a huge gender gap. I think I shared it with you in
God,
terms
it's
of
amazing.
confidence level around finances and investing. So it's so
Yeah.
hugely needed. And yeah, I'm excited for
And
your platform
it's
to launch.
it's fascinating and not in a happy way,
Yeah,
it's mind-blowing.
yeah.
Exciting.
Um, so what inspired you to get into investing in financial education?
So that's a good question. I guess, I went to fancy school for finance and I was working on Wall Street with all these, you know, sort of big wigs. And I realized that I had friends that weren't making a lot of money at all. And then I knew guys that were making millions of dollars a year. And some of my friends that made very small amounts of money, or my family, teachers, anyone, they were actually better. They actually had more cash on hand than some of the guys making millions. So I realized it's really not what you make. It's like the ability to understand money and how it could work for you, and also living below your means, which anybody can do no matter how much you make. And I realized that all these guys with the fanciest and best educations and MBAs, some still didn't know a lot, and women were just not taught in school about personal finance. And so I started to become really passionate about that, and I started speaking to first generation college students about it. And then that kind of morphed into seeing studies like yours and the gap between women and men, which is shocking. So I'm really inspired by that.
That's so good. Yeah, it is inspiring to know that you can manage your money no matter what you're making. I think a lot of times it feels like you just need to make more and more and more when you have money to work with. So I'd love to just dive into kind of the basics around investing because and take some of that I don't know, just mysticism off out of it and ask you to explain some of the key concepts and terminology that every beginner should know about investing.
Sure. I think there is a lot of mystery around it, and there really doesn't have to be. It's not magic. It's really a science. Um, I think that important concepts are, like I said, living below your means. I think it's important to know the different types of accounts out there, because I know online everybody's like, open this account, open this account. There's just, it's overwhelming. And I think it would be great if people knew which accounts come first. As you're building your wealth, when you're first starting, you don't have a lot. What is the most important thing to start with? So I can talk about that in a little bit. I also think it's important to know about just the basic difference between a bond and a stock and an index fund, what that is, what that means, why it's not great to leave all your money in a checking account, what's wrong with that. And I also think it's good for people to understand, if they open a trading account, it doesn't mean they're invested. It just means you opened you went to the grocery store and you took a cart, but you didn't actually put anything in it yet. And it's important to understand that, and to know that it's okay if you don't know every single thing, as long as you're not intimidated and you just start somewhere in the simplest way.
Yeah, so let's start with just the difference between saving and investing. Like, what do we mean by investing?
Okay, so when you're saving, you're putting your money in a savings account or a checking account, let's say, which is not much different than storing a bunch of cash under your mattress. You're not, it's great that you're saving, but you're not going to save your way to wealthy. It's just not going to happen. There's not enough hours in the day. You know, most of us are not going to be rock stars or, famous athletes. So the normal amount of money to just save it is probably not going to get you where you want to go. But if you're investing it, in the most basic terms, to me, investing means using your money as a tool. So you want your money to work for you. Every dollar you have should be like a little soldier working for you to get you where you want to go. And of course, there are a ton of different ways to invest. Some are safer, some are more aggressive and riskier. And there are many factors to consider, like how well do you sleep at night with a lot of risk? More importantly, what's your age? How many years do you have to invest? I would never tell a 75-year-old the same thing I would tell a 35-year-old. It's very different. So to answer your question, I'd say the main difference is that investing is putting that money to work to make more money.
Okay, yeah, I love that terminology and the idea that it's working for you. Could you started to describe this a little bit, but could you expand a little bit more on the different types of investments available? Like you mentioned stocks, bonds, like what would you say are the essentials?
Sure. So if I were a person just starting out and I didn't know a lot about the stock market and I'm intimidated, I would recommend buying an index fund which tracks the different indexes. So like an S&P index, which is the largest stocks, or you could do the largest 500, the largest 100. I would educate yourself, and there are many resources as to what index funds you can buy. So basically, an index fund is a basket of stocks. So if you don't know enough, which many people don't, to know how to value a stock, analyze it, look at charts and graphs, read about all the news coming out every day, know the CEO, know the management, there's a lot involved. And if you don't have that sort of background or that time, I think your best bet is an index fund, because you're not putting all your eggs in one basket. You're not saying, I'm going to pick this one stock and I'm going to sink or swim with this one stock. In a way, you're diversifying. I know you're going to ask me about that later, but you're getting a group of stocks. So if one has a really bad year, another one might have a great year, and they kind of average out. So it's a lot less risky. So that's what I recommend for people starting out. But then, just to give you some basic lingo, a stock, which is a share in a company, represents ownership. You own a small piece of that company, and you enjoy the up days and you feel bad on the down days. And some of those companies share their profits, which are called dividends. Not all companies pay dividends, but the ones that do will give you a payout quarterly, depending on the amount of shares you have. And you have the option to take that dividend and use it for whatever you want, or you can reinvest it, which means it will buy a little tiny piece of more of that stock. So as the years go by, let's say you started with 10 shares, and if you are reinvesting your dividend over the years, you will have more than 10 shares without ever buying more shares, because you're slowly and incrementally buying new small tiny pieces of that stock as you go along. So you're making money in two ways. The stock hopefully is going up in value, and two, you're getting a little bigger piece of the pie as you stay in it. Those are stocks. Bonds are, think of it as a loan. So you're loaning money to either a corporation or a municipality, a government, a state, a city that wants to do a project and they'd like to raise money. You would sell a bond. And by the way, they also have bond funds for people that are intimidated by bonds, and bonds are a little intimidating, even to me. So I love there are bond funds, and you can get pieces of the US Treasury bonds. And usually bonds and stocks work inversely. So when the stock market is up, the bonds, I'm not going to say this is always and forever, but sometimes the bond market will be down and vice versa. So it's also a good sort of kind of hedge protection insurance. Like in my own portfolio, I always have a little bit of a bond index just as some protection. So stock is ownership, bonds are loans. ETF, an important term, that stands for exchange traded fund. And that's basically what I was talking about before, an index fund. You can also buy a fund that is like a topic, like a themed fund. Let's say you like energy. You can buy an energy stock fund, which has a bunch of different ones in it. So you don't have to bet on one horse. Or you can buy a technology fund. I'm sure there's a million. You can buy a crypto fund, or, as many investing themes as you can think of, there's a fund for that. So I think those are the basic, most important terms that you should know before you start.
Okay, that's super helpful. And if you are just starting out, where do you recommend you go? You mentioned the fund, but do you choose to go with a platform that will help you with that, or do you do that on your own? Like, what would you say are the next steps?
Okay. I would say if you're really just starting out, the first thing I like to say is like, take a financial inventory of where you are. Know where you are now. Like when you get in a car and you put something in your maps, the maps have to know where you're starting, and you have to take an honest look about where you're starting. Do you have a ton of debt? Is it credit card debt? What are your monthly expenses and what are you making? But after you've figured out exactly what your starting point is, I think the first thing is to make sure you have an emergency fund, which should be 3 to 6 months if you're a single person, and more like 9 to 12 months if you have a family to support. Once you have all that, you're clear, you're good, you have your emergency fund. I would then open an account you can go to some of the more traditional ones like Schwab, Fidelity, or you could go to more new fintech ones. Of course, there's Robinhood, SoFi. I like Ellevest, is very sort of geared towards women. But there are a number of them. And really, if I were starting, I would get online and just sort of surf through those platforms and see which one I'm the most comfortable with, which is user-friendly. Some have more education than others. I know Schwab has a lot of learning centers, and so probably does Fidelity. And you can learn a lot on there, and you can call people, even if you haven't yet opened an account, and they will talk to you and help you. So once I figure out where I want to be, let's say that's the store you're going to shop at, and they all sell this pretty much the same thing. It's just like, what's the user-friendly platform for you? You're going to go there and you're going to open an account. Now, the big question is, what type of account? Because there are so many accounts. So I would say for people starting out, well, the first thing you want at a traditional bank is a checking account just to pay your bills. But don't leave a bunch of money in your checking account, because that money is not working for you. It's just sitting there. It's not doing anything. When your money's in that checking account, you're working for the money. The money's not working for you. But okay, you leave money in your checking account that you can pay your bills with. After that, you want to open a high yield savings account, not a regular savings account that pays you less than 1%, a high yield, which right now is like somewhere between 4 and 5%, which is very high and very nice. So take that 5%, put your money in there. And I spoke of an emergency fund. That's where you're going to put your emergency fund, in that high yield savings account, because it's not doing nothing for you, but you can get it easily. You have easy access to it whenever you want it. After that, after the high yield savings account, then I would open a Roth IRA account. That is, if you go to Schwab or Fidelity or one of the online ones, open a Roth. It's an amazing account. You put your money in after you've paid taxes on it. So this isn't money that gets automatically taken out of your paycheck, like maybe a 401k. This is an account you open, and the money you put in is after tax dollars. So you've already paid taxes on it. You put it in there. Again, once it's in there, you're still not invested. You have to buy something, but it's in there. And that money, however you invest it, however long it grows, let's say you're 20 and it's going to grow till you're 60, that 40 years of growth, and your investments can change. You're not committed to one thing. You will not pay taxes on that when you take it out when you're 59 and a half years old or 73 years old, somewhere in that area. So you just got all that capital gains without having to pay taxes, because you pay taxes in the beginning, and the government really doesn't tax you twice. So a Roth IRA is amazing. That's where I would start. If you have a job and your employer has a 401k, I would absolutely take that. And I would automate that, so you don't have to think about it every month. It's not like when you wake up and you're like, should I go to the gym today or not? You're probably not going to go. But if it's just automatic, you don't have a choice. That money comes out before you see it. You'll be amazed at how it grows. And so the difference between a 401k and a Roth is that the 401k takes money out of your income before you pay taxes on it. So it actually lowers your tax basis, which is good. But then when you're older and you've made a lot of money in it and you sell it, you will have to then pay taxes on the capital gains at that point when you're older. But the idea is that when you're older and retired, you may be in a lower tax bracket because you're retired and you're not in your highest earning years. So it's okay because you can be in a lower tax bracket. So it may be okay to pay the taxes on it then, as opposed to when you're in your prime.
Okay.
That's
Oh,
a lot, I know.
yeah.
It's a lot
I
of
mean, it is a
information.
lot, but you're explaining it really simply. So I appreciate that. I would like to talk about returns for a second as we're thinking about these different types of investing. So you mentioned 4 to 5% on a high yield savings account. What should we expect from investing in the stock market or ETFs and a Roth IRA, for instance?
Okay, so that's such a broad range. Just like there are stores that are really cheap and stores that are ridiculously expensive, there are stocks that may be higher risk that have higher returns. And then there are very, very safe, low risk investments that may have lower returns. So I will just say that the stock market over the last 90 years, on average, some years it's up, some years it's down, on average has returned 9 to 10%. So like when I look at compound interest charts, I'm using 10%, even though some years maybe there's a market crash and it's down, and if you didn't really lose that money until you sell that money. But if you panic and sell, then you lost money. So you have negative returns. If you stay in and wait, over time, it's going to average out to be about 10%. That's what you should expect. So you might say, Wendy, why would I do a 5% high yield savings account when I could get an average of 10% in the stock market? It's just riskier. You're taking risk in the stock market, and there's no risk in a high yield savings account. You're not going to go get your money out and they say to you, oh, your $200 is now $100, but that can happen in the stock market. So the reward you get for taking that risk is higher returns.
And what about in an IRA account?
Okay, so I mentioned a 401k and a Roth. Those are both types of IRA account. So IRA just stands for individual retirement account. There are many types. There's a simple IRA, there's the Roth, there's a 401k. There are a bunch of different IRAs, and you have to figure out which one is right for you. And it really depends on your circumstances. Are you a business owner? Are you an entrepreneur? Are you a gig economy person? Are you employed? And depending on your situation, there's an IRA for that. So, and again, when you, of course, if your employer has a 401k and they max that out, because that is free money. It rarely happens anymore, but it happens, and it's a huge gift. So if you're working for someone and they have that, that's a retirement account you should have. That's the one. If you're not and you're doing it self-directed on your own, I suggest a Roth or a traditional IRA. Let's say you're making a ton of money right now, and you're in a very high tax bracket, you may prefer the traditional. You may prefer to push that tax liability down the road to when you're older and you're not making as much money. So it really depends on your circumstances. I would definitely do some research on different retirement accounts, and at some of those platforms where you might open an account, they have a whole section on retirement usually. So you can click on that and get info.
I think it's so important to recognize, like you were talking about, the short term versus long term risk and benefits in these different types of investing, because in a world where we know about crypto, and I don't know, tech booms and things like that, where you can expect something really quick and amazing. Whereas, in the stock market, it might fluctuate. You're expecting a longer term return, and same thing with retirement investing. And I feel like, acknowledging that the younger you are when you start investing, the more benefit you're going to get. Can you speak to that a little bit about like what it means to start investing in your retirement, or, at a younger age versus when you get older?
So I have this great compound interest chart. I'd be happy to send you, Kristen.
Yes.
Um, it's great. And basically I give an example of three different people, and one investor started investing in their late teens and put $2,000 a year, which is not a lot, away for 6 years. My next investor started at 21, put 2,000 a year for 7 years, and the last one started at 28 and invested for like 30 years, same 2,000. And amazingly enough, the one that started young and only invested for 6 years, which wouldn't happen because you're not going to stop investing in your 20s, ends up with over $1 million. And the other two end up with under $1 million, even though they invested so many more years. That's compound interest. That's the miracle of compound interest. So people ask me what to buy. It's not what to invest in, it's when. Like, the earlier, the better. I cannot stress that enough. And if you're listening and you're 35 or 40, it's not game over. Like, there's catch-up contributions. There are definitely things you can do to catch up. But if you're a young person, you have the biggest benefit of all, which is time. So compound interest in the simplest terms is when you make an investment and you get interest, and then over time, you're getting paid interest on that interest. And then you get paid interest on that interest that you made interest on. And it's hard to explain without actually seeing a chart with numbers, but it's a very, very powerful, probably one of the most powerful tools in investing is compound interest.
Okay, so I'd love for you to share a little bit about some of the additional resources and experience that you have. So what are some of the reliable resources early young investors could go to learn more about investing?
Okay, I know, well, I will be launching something that's called the Official Money Check, and it's not out yet, but it will be a platform, it will be YouTube, and I'm going to do Finance in 5, and I will try to break down complex financial concepts in 5 minutes or less. So I'm hoping that's a resource for people, and we'll also have an Instagram and all that. And I will interview successful people, non-successful people, and see what people's sort of money psychology is and what they've learned. Other great resources are, I can give you 3 books that I love. One is a classic, Think and Grow Rich by Napoleon Hill. It's a little dated. It was written in like the early 1900s, but the concepts are not dated. So I think that's kind of like money mindset book. I think it's excellent. I also like The Intelligent Investor, which is a classic. And since I gave you 2 classics, I'll give you a very new one, which is The Algebra of Wealth by Scott Galloway. He's everywhere. He's a professor at NYU. He's all over social media right now. But his book is excellent. So I do recommend that. And again, any of these traditional platforms like Schwab, Fidelity, they do have great research. I think those are probably the best resources I would start with.
Okay, that's super helpful. That's great. And we'll link out to all of those as well. So getting into some of your experience, what are some of the common mistakes new investors make? And do you have any suggestions on how you can avoid them?
Sure. I think some of the mistakes are, number one, waiting because you're overwhelmed or you don't know what to do, or you think, I don't have money to invest right now, but you never have extra money that you're like, I have nothing to do with this money. So waiting is a huge mistake. Getting caught up in the meme stocks, huge mistake. I would not recommend that. It's so tempting because you see people, getting ridiculous returns, but it can just as easily go the other way. So unless you're a professional day trader, I would stay away from that. And I'd say the third biggest mistake is, actually I have four. So number three would be ignoring your debt. If you have debt, let's open your mail. Like, it sucks. You don't want to see it, but see it, hit it head on, pay off your highest interest rate credit cards first, and then cut them up. Just really get on top of your debt. And the fourth mistake is letting somebody else handle your money for you. Don't give that away. Somebody else can help you with it, great, but you have to be involved. You have to be in there and have an idea of what your money is doing, where it is. You should know the location of it. 80% of women are going to die after their partners. So, and something like women take something like on average 11 and a half years out of the workforce to men's only maybe 8 months. So, it's really important that we don't give this up to anyone else. It's really important that women especially are good at this stuff because we live longer and generally get paid less, which I can't believe is still a fact, but it is.
Oh, you are speaking so directly to me. This has always been my challenge is I feel insecure around, especially around investing. It's just like, I avoid it. I feel like I don't have enough money, but then when I do, I still avoid it. And I want to have someone else make those decisions for me. And so I've always done that where I tend to, even having a financial advisor, that's great, but I ultimately come back to realizing that I have to I have to be at the center of that, and I think it's a really powerful experience. Like, it's very much been I think life-changing for me to take control over my finances and make these kinds of investing decisions because it's a powerful thing. Wealth is powerful, and making those decisions is really powerful. So I'm so glad you're doing what you're doing.
Oh, thanks. And I totally agree. And if you have the luxury of having a financial planner, it's amazing. But it's like having a personal trainer at a gym. You still have to direct them where you want to go. Do you want to look like a huge bodybuilder? Do you want to have a yoga body? You kind of are in charge. So that's
Like a
super.
good analogy. So I know you've talked about this throughout, but what would be your advice for someone who's just starting out on their investment journey?
I would say, don't be intimidated. Reach out to good resources where you can just get advice, ask questions. No question is silly. And don't take advice from people who are not in a position you want to be in. Like, you'd be amazed how many people like, well, my uncle told me this. Well, how's your uncle doing? Not so great. Or my friend who lost all their money on GameStop told me that, take advice from trusted individuals and know that, I know it's intimidating, but it is actually a formula. Like, I'm not a great cook, but I can bake a cake because there's directions. And there are directions to this. I can't give you directions to get rich quick. That involves a lot of luck. Sometimes it happens, sometimes it doesn't. But this, I can give you directions, but it's slow. I mean, it's a slow process, but you will get there. Recently, I showed someone this compound interest chart and they said, do you mean that if I start now putting 2,000, I'll be a millionaire by the time I'm 50, 49. And I said, yes, like it's facts. It's real. So just don't sweep it under the rug and just go for it. You can't, if you're conservative with your investments, you have nothing to lose.
Okay, is there anything that we haven't talked about today that you think would be important for a new young investor to know about?
Well, we talked a little about living beyond your means. And so I'm kind of just going to a little bit talk about good debt and bad debt, and just to say that good debt is debt that is going to get you ahead in life. Good debt is debt that's going to get you to the next level, or it's going to get you to up your skills. Wealth is like assets and skills and investments. It's not cash. It's not a $5,000 bag or shoes. Debt that you spent for material things that are going to give you temporary joy is not good, and you don't need that. It's not worth the long-term stress of being stressed about money, which, by the way, has huge health effects and is a leading cause of divorce. So, I would just say get your money right. It's way more important than having fancy clothes or bags.
That's so good. Any last words for our audience? And also, I know we're in pre-launch at the time of this recording, but tell us where we can follow you as well.
Yes. So a secret I'm only telling your people, it's theofficialmoneychick.com. I'm so excited. And it's also going to be on Instagram. You can actually follow now, even though we don't have any posts yet, but we will in a month. It will be Official Money Chick on Insta, and we'll have a YouTube channel, which is also called Money Chick or Official Money Chick. Not even sure yet. That's how new it is. So please come check out. We'll have a lot of resources and the ability to ask questions if you want some personalized attention, and hopefully it'll be inspirational.
Awesome. Well, I am so excited about your platform and so appreciate you taking the time today to talk with us.
Thanks, Kristen. And of course, I love what you're doing, and I look forward to seeing where that goes.
Yeah, great.
Oh,
Thank you.
bye.